Welcome to the YFP Real Estate Investing Podcast. I'm Nate Hedrick.
And I'm David Bright. We're both pharmacists and real estate investors that believe that real estate investing does not have to distract from a meaningful career in pharmacy.
Each episode, we share stories that educate and inspire pharmacists to leverage real estate investing as a part of your financial plan. Hey, David, how's it going?
Hey, good, thanks. How you doing, man?
Good. We've got a lot going on. We just had a trip to Disney with the kids. We just had a move out after a messy eviction with a tenant, and it's a lot of craziness, but the property's on the market for sale. I've got a great real estate agent handling it for me, which is really nice. So it's just kind of set it and hope for the best.
Yeah, those are kind of like the opposite ends of the spectrum, right? Like a trip to Disney, right. Huge positive. Eviction is like everybody's nightmare in the rental property investing space, right?
Yeah. And it just feels like, again, there's always the good and the bad, the ups and the downs with real estate investing. It just felt like a week of both of those, like in the same time period. So anyway, we're doing good.
Yeah. No, it's fun to sometimes see those get cleaned up because that's oftentimes the worst. And so just kind of getting through that, getting that cleaned up, getting that house put back together, make it safe and respectable again. Like sometimes I can be climbing back out of that, and that can be really positive. And particularly because this is one you're listing and selling now, right?
Yep. It's on the market. And again, I don't want to jinx it, but this episode will come out in a couple of weeks. So we got an offer. So we'll see. Hopefully it pans out the way we want it to. So that's good.
Nice. I feel like that's a fun part of the process too. Like not only in this case to put a headache behind you, right? But I'm assuming that you did a little more math in this. It wasn't just this like, this is stressful, I want to sell this. I know you're a methodical kind of pharmacist. So I'm assuming you did a little math and put that all together, and that's what helped make that decision in the end.
It really was. It was a decision based on math, right? Because this was actually a good rental. I was sad to see it go, or will be sad to see it go, I think, when we finally close. But one of the things I have to always kind of assess as we're looking at our portfolio is, what properties are worth keeping? What properties should we, use the gained equity that we've gotten from owning it for a couple of years and invest that in other projects, or set that aside for something different, right? Or just get out after a good tenant turn. I mean, this one felt like I was ready to sell it anyway. And after that eviction and all the mess we had to go through, like we basically had to redo the house, like redo the renovation. And so at that point, it's just like, well, the house is bright and fresh and shiny. Like maybe we should just sell it. So it was a number of factors that went into that decision.
Yeah, I think that's really good. One of the things that you and I have been talking about for weeks, which is why I wanted to try to pull this together as a deep dive episode, is that there's really different market conditions now than what we had expected a few years ago. Like you and I had both bought houses pre-pandemic. We had not remotely anticipated this level of appreciation. And I think that this amount of appreciation forces kind of a reconsideration of, just like you said, what do you do with that equity? There can be a lot of equity trapped in houses if there are investors that have had houses for a minute. And so this can be an opportunity to look at some key metrics and figure out what that means. And I think two of the metrics that you and I have been discussing a lot, we figured we'd pop into this episode, would be cash on cash return and return on equity.
Yeah. And hopefully that's not, everyone's thinking, oh my God, this is a math episode. Like, boop, turn it off. I promise we'll make it a good podcast episode. I promise. Really what we want to do is break apart those metrics so you can have better confidence with your own investing and see some real numbers based on actual, plays, because that's how you're going to be able to make decisions.
Yeah. It's so hard to figure out what's good and bad just by feeling, right? But by putting some metrics together. And I think as pharmacists, we're wired to get metrics, right? And sometimes those metrics paint a really, really crystal clear picture. Like I can think about drugstores that I've worked in that filled 100 prescriptions on a Monday, and drugstores that I've worked in that filled 800 prescriptions on a Monday. And I think everybody listening to this already like has this mental picture of those two very different stores, very different feeling, team size, what that's going to look like, how operations work in those places. And so sometimes those metrics just bring a lot of clarity to what seems like a complex decision or a complex description.
Yeah, I think that's spot on, right? Sometimes you can use that one piece of data to create a much bigger picture. And so again, for today, the two big pieces of data we're going to focus on are cash on cash return and then return on equity. We'll break down what those mean.
Yes, let's go ahead and start with the cash on cash return then. I think that's that first metric that a lot of investors look to when they start their analysis of whether they feel that a real estate investment is performing well or not. So Nate, I know you're a Cleveland guy. If we think back to like pre-pandemic, if we were looking for a rental property in the Cleveland area, there's probably a suburb around Cleveland somewhere where you could have at one point in time picked up a 3-bed, 1.5-bath rental house for, let's just say 160 grand for rough numbers, which on a 25% down mortgage would be $40,000 down.
Yep.
After the pandemic, I'm sure that's gone up a little bit. Let's just say conservatively, it's now 200 grand from 160. I have a feeling there's a lot of areas of Cleveland that probably did better than that, but let's just assume it only went up to 200 and rents for 2,200 a month. Back on episode 50, we talked through all of the expenses that you could expect on a long-term rental property. So things like property management fees, your mortgage, your property taxes, insurance, repairs, vacancy, those kind of things. So let's just assume that all adds up to $1,800 a month, meaning that the $2,200 in rent minus the $1,800 in expenses leaves you with $400 a month of cash flow. Just for really rough numbers, let's just say $400 a month instead of calling that $4,800 a year. Let's just call that $5,000 a year, just to keep it really simple. Mm-hmm. So in essence, you have put $40,000 into buying a house, a $40,000 down payment, and it now returns about $5,000 a year in cash return. So Nate, with those numbers, can you walk us through the cash on cash return?
Yeah. And just like the name would suggest, right? We're figuring out what kind of cash we're getting as it relates to the amount of cash that we put in. So you said we put $40,000 in. Let's assume, just for the sake of easy math, right? There's no renovations, there's no work required, whatever. It's 40 grand all in. So then what you basically do is you take that return that you're getting, that $400 a month or $5,000 a year in this case, $5,000 a year divided by $40,000 invested is 12.5% or a 12.5% cash on cash return.
I like it. So different investors are going to want different cash on cash return levels. But if we just kind of zoom out, there aren't a lot of investments out there that produce a 12% return on the investment or 12.5% return on the investment. So just even at face value, that doesn't sound so bad. But in this case, the property also went up in value by $40,000, right? We said this is a $160,000 house. Now it's a $200,000 house. So you went from that $40,000 in equity, which was your $40,000 down. Now you have $80,000 in equity. So, I mean, granted, if you were to sell that house today, there'd be realtor fees, there'd be transfer tax, there'd be all those things. So you wouldn't walk away with $80,000, but you might walk away with $60,000, your down payment back plus a chunk of appreciation, right?
Yeah, you're spot on, right? That's why we have these two different metrics. So we said 12.5% cash on cash return, but that is cash on cash, right? That's all that's showing you is what are you getting today in relation to what you invested up front. And again, as you get further and further away from that initial investment, the cash on cash might mean a little bit less over time. It depends on how you run your metrics. But again, that's something that you have to kind of keep an eye on or keep in perspective. And what it doesn't tell you anything about is that equity gain. Like, what did you actually get to that appreciation? So if we assume for a minute that the owner chooses to sell the house, like let's take that option, right? We sell the house in today's hot market, and the net effect is that they walk away with that 60 grand that you mentioned. Plus they've made about $20,000 in cash flow over the last 4 years, give or take. That's like putting $40,000 in a house and 4 years later getting $80,000 out, right? Essentially doubling your money. Pretty interesting when you look at it in that vein and comparing that to other investment options that are out there, stocks, bonds, equity funds, things like that.
Yeah, doubling your money in 4 years really certainly doesn't sound that bad. And so I don't know that any of us really expected real estate to skyrocket quite like it did in the last few years, but I'll bet that this situation applies to a lot of people, even with their personal residence. Even if folks listening didn't necessarily buy a rental property pre-COVID, if you had a personal residence pre-COVID, I'm sure that that appreciation was there, and it could have been even more significant, like we mentioned, on a percentage basis than what this example shows.
Yeah, and this is really one of the reasons that many investors try to find ways to put as small down payment as possible, right?
Yeah.
You're really using the ability or the advantage of someone else lending you the majority of the funds and leveraging those other people's monies to get the biggest return that you possibly can, right? I mean, if you bought the house, let's say you did a pharmacist home loan with 3.5 or 5% down, right? And you lived in it for a while and then rented out or something, or you're still living in it today with that low mortgage. I mean, now you're talking about an enormous cash on cash return because of that hugely small down payment, right? You have no money invested, but you're getting all this return from that money that you've put into it.
Yeah, that's why one of the strategies I really love is buying a house as a primary residence and later converting it into a rental. Because if we just put numbers to that for a second, let's say, Nate, that you would have bought that $160,000 house in Cleveland with a 5% down owner-occupant mortgage, meaning you put 8% down to buy that house. Then after a few years, you move out, get another house, but you keep it as a rental that's making $5,000 of cash flow annually, and you only have $8,000 into that house. So 5,000 divided by 8,000, that's a 62.5% cash on cash return, which when we already said that 12% doesn't sound so bad, 62.5% cash on cash return sounds like wildly good.
Right. I mean, it sounds crazy. And again, if we take a conservative step back just for a second too, right? This is exactly the risk of things when they go the other direction, right? Like if appreciation drops and you have no money invested, all of a sudden your cash on cash return goes negative, and it goes negative very quickly, right? Because you're losing so much money on this small amount that you've invested. You had no equity to begin with to kind of buffer that, right? So it can be a double-edged sword if the market is trending downward, but if it goes like it has been the last couple of years, that's when you can really start to see these returns. You know, I think the other thing this makes me think of too is why so many people wanted to use the BRRRR strategy or the BRRRR method, something we've talked about extensively on the show. We covered it in depth on episode 75. And just it allows you to really limit the initial cash invested. And even if you have to put a bunch of money up front, you can get a lot of that back so that you can limit your exposure.
Yeah. Yeah. So there's definitely ways to push for that really strong cash on cash return, whether that's getting an owner occupant mortgage, later moving out and retaining the property as a rental, using the BRRRR method so that you refinance back out a lot of your cash and keep that equity down. And those strategies can be helpful, particularly if the cash flow is a big part of your financial plan, or you want to minimize the amount of cash invested, or both.
Yep. So we've talked a lot about the return, the cash on cash return, but what about the return on equity? What does that mean? What does it look like for the same example property?
Yeah, I think this is where this gets a little trickier, but I think in a market where we've seen some pretty rapid appreciation, I think this is a really critical metric to look at. So if we go back to that original property, bought it, it was a $160,000 property, and you had $40,000 of equity because you put $40,000 down, cash flow of $5,000 per year, your initial return on equity is the same that we were talking about, $5,000 divided by the $40,000 in equity, 12.5% return. But as the property value went from 160 to 200, meaning the equity went from $40,000 to $80,000, we'd have to take that $5,000 of cash flow and divide it by the $80,000 of equity. And so instead of 12.5%, we get 6.25%.
Which makes it feel like a lot worse, right? So, and we'll explain why that is in a second, right? If you're not following, right, why is the number lower? Right? I promise we'll get there. And again, in normal circumstances, right, we would see rents go up slowly and those property values kind of go up slowly with it, meaning that cash flow increases as the equity increases, and the return on equity can really, it stays pretty stable in most markets. But the appreciation we've seen the last couple of years has been just so different and so rapid that it's really kind of blown some of that up.
Yeah. So really one key update that we want to focus on today is that in today's market, the dramatic appreciation in price that we've seen in recent years has changed how much equity an investor may have in a house. And so particularly we can see that return on equity figure drop dramatically as we see the equity itself increase dramatically.
Right.
And if we want to make it even more complex, we could look at the case of like a renovation model, like you mentioned with the BRRRR model initially, and that can exaggerate this even more, right?
Yeah, I was just going to say, right, that can really start to show, it helps to show the example if you can go to the extremes, right? So if you take someone that bought an exceptionally hot market house, right during the middle of the pandemic, you did some renovation to force appreciation alongside what the market was doing, you might even see, double digit, right, or doubling of the value of that house, right? And your equity goes just through the roof.
Yeah. So let's walk that out with real numbers, because I think that those numbers will help it to make a little more sense. So same $160,000 house, You put $40,000 down.
Mhm.
You did $20,000 into renovations. Say you were trying to add a bedroom and a bathroom in the basement or something like that. And that took the value from 160 to 220 because you increase the bedroom count, the bathroom count, that increases the value. That's a strategy that a lot of investors do. And that creates some initial equity right out of the gates. But then the pandemic hits and that $220,000 house becomes a $300,000 house.
Yeah.
So because there's, you only put $60,000 of cash into it, your $40,000 down payment and your $20,000 of renovations, you're looking at not a lot of cash invested, but your original mortgage amount of 120, now that house is worth 300, you could have $180,000 of equity in that house off of a $60,000 investment. And Nate, I know you're, again, talking about Cleveland real estate, but is that in the ballpark of what you could see in Cleveland right now?
Yeah, absolutely. I mean, and I know lots of other areas of the country where it's the exact same story. I mean, people are seeing what feels like overnight increases on their value of this home. And it seems unreal. And again, it's something we've seen played out just because of the rapid appreciation over the last 2 years.
Yeah. And if we play that out from a cash flow standpoint, like in this model, if you're adding bedrooms and bathrooms, you're probably going to get a little more rent. So let's just say that the little bit more rent creates a little more cash flow. You're at $8,000 a year of cash flow instead of $5,000 because you made some improvements to the property. If we take that $8,000 of cash flow and we divide it out by the equity, which in this case is $180,000 now because the market skyrocketed so much, now we're at a return on equity of 4.4%.
Yeah. And so if we take a step back and think about what that means, right? What we're saying is that based on the equity you have left in the house, based on the money you could get if you sold it today, what are you actually getting per year? It doesn't tell you how much you're getting on the initial investment. It tells you how much you're getting on what the investment is at today, right? If I sold it and took all that cash, what am I getting on that amount? And that's a very different number than cash on cash return, but it's important, right? It's important to realize that, especially as we've seen these appreciations go up. So I guess, David, as that return on equity number starts to drop and we get to something like that, right? Maybe I have $180,000 in value, but I'm not cash flowing very much. What are some strategies that investors can use to get more out of that and maximize their return?
Yeah, and it's kind of a complex question because it's not something we see in typical market scenarios.
Right.
Typically, we see the rents go up kind of in pace with property value. So the cash flow is going up, the equity is going up, but the return on equity is still pretty solid. In some situations, one strategy that investors can do if they are accumulating a lot of equity in a property is an investor could do a cash out refinance. So get a new mortgage on the property, leverage a lot of that equity, pull some cash out. And in some situations, investors love to do that because that creates more cash to go buy another rental property or another investment of whatever kind. The problem in this market is if you did this back in 2019, 2020, 2021, and you got some 3 or 4% mortgage, if you were to refinance that today and you're talking 8 or 9% mortgage, not only are you borrowing more, so your payment is higher, but you're borrowing at double the rate, which is going to significantly increase your payment. And so that might wipe out all of your cash flow or even cause a property to go cash flow negative because of today's interest rates.
Yeah, we actually had a property that we bought right as interest rates. Well, we bought it about 2 months before interest rates spiked, and I had about 4 months of renovations to do on that property. And so when the 6-month window for our refinance, right, the old school BRRRR strategy, when that came up, it went from being an easy BRRRR, like it would have been a perfect BRRRR, to I can't refinance this because the interest rates will crush the cash flow so much. I mean, literally in 6 months it did that. And so we're actually sitting on that house today. I love that house, but I don't know that I'm ever going to be able to get out of that loan because it's at like 3.5%. When's the next time I'm going to get that on one of those? It's just crazy.
Yeah. So that makes it really difficult to get out from that mortgage, particularly when a lot of pharmacist investors like you and I really like having a cash flow positive property, right? Yeah. Like we don't want to, certainly people make a lot of money from appreciation over time. I don't want to downplay that. Mm-hmm. But I know you and I talk often about how we don't want to bet only on market appreciation. Yep. It's sometimes helpful for us risk averse pharmacist investors to want to have cash flow or at least not be cash flow negative. Certainly there's an argument that someone could buy $100,000 house today and it'd be worth 500,000 30 years from now. And if it pays for itself on a monthly basis and doesn't generate a lot of cash flow, just from a really rudimentary, simple analysis, that might be a fit for somebody in their investing strategy, particularly if that house will be paid off by the tenants over that time. So you make a down payment today, you wake up 30 years later and you have a $500,000 paid for house. Like, that doesn't sound so bad, but a lot of investors want some cash flow with that, just to cushion for the experiences like you talked about at the beginning of the show here, with a painful eviction and a big remodel.
Yeah. And I think that's exactly where like my risk averse pharmacist brain jumps in, is like, I need the cash flow for defense, right? If something goes wrong with the investment, the cash flow is what protects it. I'm not doing that to like, replace all my income and quit pharmacy forever. No, like, I need it as that cushion. I'm building up a reserve fund so that when something breaks, when something goes wrong, when, the unexpected occurs, like, the properties take care of themselves and I'm not worrying about it.
Yeah. Yeah. So then let's talk about the scenario. If, we started out, you're not going to keep this property for 30 years, because theoretically you could, right? You have a really good mortgage rate. You could see this one through and keep it for 27 more years or whatever, and it would be paid off, right? And so there's something to that, but you're looking at a shorter term ownership strategy. And I think we've had a lot of conversation when we're not recording this, where I'm doing some of the same stuff, where you and I both watch values go up pretty dramatically in a couple of years. And it just seems like it makes sense to sell, right?
Yeah. And especially in this case, I mean, the house that we kind of opened with, the one that I just listed, we're talking about, and we saw the value of that property go up almost 50% in just 2 years. And so, the cash flow hasn't really changed much at all in terms of the rents. The rents have gone up a little bit in this area. It's an out of state property and it's gone up okay, but it really has not kept pace with appreciation at all. And so that return on equity is just plummeted, basically.
Yeah. And so if we look at that return on equity, particularly if you're thinking about re-renting it and the rents haven't gone up and you're not expecting a lot more cash return on the numerator, if the denominator has gotten really big and that rate is really low. I don't know if you've done the math on what that rate looks like or anything.
Yeah. So the rate on the refinance
or the rate on the return on equity for
no, I haven't done the math on this particular property. No.
Yeah, but I know I've done the math on a couple that I've looked at, and I've been in like the 2 point something range. And so like for some of these, it's like, when I look at what CD rates are right now, like I could go get a CD with the equity and have double the cash flow that the rental property is, right? So, and I'm not necessarily saying that's a great strategy, but man, it certainly has a lot, like CDs have a lot less risk, and index funds have a lot less risk, and bonds have a lot less risk about like toilets getting plugged or paint jobs needing to happen, right? Like that doesn't happen there.
But, normally, like if you had talked about this house 2 years ago and let's say we're in the exact same situation, but it was 2 years prior with the rates they were, it would be an easy discussion, right? I'd pay $1,500 or $2,500 to have it refinanced and do a cash out refi, and all that equity, they could send me 75% of it in the form of a check. Right. And then I would just keep rolling, but it's not an option right now in this market. And so you have to kind of look at that equity differently, because you can't really access it like the way that we could a couple of years ago.
Yeah. And so with that appreciation, like we talked about riding that wave of appreciation, seeing the property go up 50% value in 2 years, you said, is there any part of you, particularly with your realtor hat on, is there anything that makes you tempted to continue riding that out and see more appreciation happen over time?
So part of me, yeah, right. Like I'm a big proponent of long-term investing, buy a place, sit on it for 30 years. Like you said, like I want to like wake up and those properties can just be like their own thing. Right. But I also realize that if the cash flow on those properties is low and I can reinvest that capital and the equity that I've gained in something that is a better project for what we're trying to strategize with, then that's what we're going to do. So if like for us, we're trying to get away from non-local markets at the moment, just trying to get things back here to Cleveland, mostly because of the amount of work that I'm doing in the real estate space and real estate professional status and all that goes with it. So we're trying to get things back here locally. And so part of that strategy is like, well, we've got equity sitting out of state. Let's get some of that equity back in state. That's actually been one of the driving forces for a lot of these decisions.
Yeah, I think that makes sense. And particularly, I know you and I also like the strategy of rehabbing properties and forcing appreciation. And there's oftentimes a ceiling on that. Like you can only improve a property so much through renovation, right?
Mm-hmm.
And I know you sent me the listing. So I looked at the pictures and like that one looked sharp. Like I don't know that there's a whole lot more that you can do to force appreciation in that market. So kind of resetting that, buying another fixer upper with that equity gives you opportunity to force appreciation in another market, on another property. I think that can make sense.
Yeah, I'm all for getting creative, right? Like if I could split the lot and build another house, or right, there's ways to get fun with it. But in this particular area and this particular property, it's like we've done what we can, right? This is a nice home. We've made it kind of in line with the nicest houses on the street. It's time for it to move on and let a family enjoy it or whatever.
Yeah. So essentially, if you have a property that you don't expect a ton of additional appreciation right now, you're looking at return on equity and it's in that 2-3% range, and you know you could do better on that return on equity by buying another property, then maybe for you, this is the time to sell and reposition that equity into a different investment.
Yeah. And so again, like I said, for me, like for this one, it's time to reinvest those funds into a larger property with better cash flow, something that I simply can't do in the market that this property is located in today. It's just not going to work.
Yeah. And I want to just really emphasize that you're doing right there, that you have a plan for this. You're not just like, oh, it went up in value, I'm going to sell and I'm going to stuff all this cash in my mattress, right? Like, no, you have a plan for something to do with this because it is still a pretty decent investment. You're just finding a way to have a better investment with that. So you have a very intentional plan to reinvest those funds and watch your money continue to grow.
Yeah, I could just see Kelly or Tim, my financial planners at YFP, giving me a call to say, well, "You're doing what with that money, Nate? Like, absolutely no mattress money. We gotta put this to work.
Yeah.
Come on."
Yeah. And we've talked, I'm doing the same kind of thing with a few houses that I have. We've put a few on the market where they've just appreciated. We've kind of maximized what that appreciation could be. And, as I'm also looking at things in a larger multifamily space, as much as I like the single family homes, it's nice to kind of diversify those investments and take that equity and park it somewhere else. So, but again, yeah, I only started down that road because I did this math and I was like, do I really have like a 2 something return on equity? It feels like I should be doing better on my investments than a 2 something return, right?
All right, now I'm going to do the math and figure out mine so I can see how bad it actually is, right? Make sure I made the right decision. I like that.
Yeah. No, and I think that's just a good kind of mental exercise to check in with, even if you've had a property for 5 or 10 or 15 years, like particularly given the appreciation we've seen in recent time, that can be just a nice check to do once a year or something like that of like, how is the property doing? Watching those metrics and making sure there's not a small optimization by selling a property and buying something else that could really drastically improve returns.
Yeah, it might even be a good time, like you said, just to call up your agent and say, hey, any idea what this house might be worth today? Can you do a comparative market analysis for me? Give me an idea what this property might be valued at. Don't go trust the Zillow's estimate that it's made up and my realtor gets angry at Zillow. But really, like, try to figure out what the property might be worth, and then you can make a better decision on what to do with it.
Yep. And again, I recommend if you haven't listened to it in a while, or if you haven't done the math in a while, the episode 50, we talk about that and the spreadsheet that's associated with that. So you can do some of that math while you're bugging your real estate agent for a property value. Also try to see what should rents be today, particularly if you've had a long-term tenant in that property. Maybe the rents are artificially low and that's going to cause a really low return on equity. Maybe the solution is it's time to raise rents, So there's a lot of different factors. And yeah, I think finding a trusted professional, doing your math can be a way to make sure that you are optimizing your investment.
Great points, David. Well, guys, hopefully this has been helpful. Hopefully you now better understand cash on cash return on equity. If there are other metrics, other terms, other strategies you want us to discuss or have questions about, please hit us up. You can find us on our Facebook group, the YFP Real Estate Investing Group. You can find David and I on Instagram. You can find us on LinkedIn. Hit us up on our website, yfprealestate.com. We'd love to talk to you guys and learn more about what you're interested in. But again, hopefully this gives you some perspective on just two important metrics in today's market, and maybe you can take it and run with it. So with that, hope you guys enjoy the rest of your week, and we'll see you next time.
Thanks for listening to the YFP Real Estate Investing Podcast. If you like what you heard in today's show, please leave us a review and subscribe to the show so you never miss an episode. If you have a question, know someone that would make a good guest, or want to connect with us, head on over to yfprealestate.com and join the growing YFP Real Estate Investing Facebook group.
As we conclude this week's episode of the YFP Real Estate Investing Podcast, an important reminder that the content of this podcast is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in this podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with their financial advisor with respect to any investment. Furthermore, the information contained in our archive newsletters, blog posts, and podcasts is not updated and therefore may not be accurate at the time you listen to it. Opinions and analyses expressed herein are solely those of your financial pharmacist unless otherwise noted and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer.
Thank you for your support of the YFP Real Estate Investing Podcast. Have a great rest of your week.